Hi everybody. As you know, we work in big venues. You're sitting at the back, you can't see the board. Maybe this might help you a bit. This exercise, I put it together to show you the process from the beginning right through to the financial statements. And I hope you can work along with me. I'm going to try and do it quickly because I don't like these things going on for long. And you can then see if this can help you. In the class tomorrow, I'll give you a worksheet which you can use, and you'll take it from there. So the 4 transactions, on the first day, the owner put in furniture that he had previously owned. This is a sole proprietor, so he did own it, he still owns it, but he's transferred the asset to his business. The second one, 2 counselling sessions a day, 250 Rand per session, that's 500 Rand per day. For 200 days, that's 100,000 Rand. Then he paid lights 12,000 and rent 28,000 to the landlord. That was for the whole year. Okay, so they paid it in arrears. In other words, they paid it on the last day of the year for the whole year. And finally, he transferred 48,000 Rand out from his business account for his salary. And the required says here, using the templates below, summarize the transactions in a worksheet format, and then into a general ledger, prepare a trial balance, and then get out your financial statements. So firstly, you can see here there's asset and there's equity here. There's no liabilities. Now, if we want to learn how to summarize transactions, one of the important things to remember is that assets equals equity plus liabilities. If you have a look down at the bottom of this worksheet, you see the financial statements, you can see that this formula presented like this. Another way to present it is equity equals assets minus liabilities. So you can see that with a little bit of simple maths, I can convert this into this format here. And this is the format that we use. Assets equals equity plus liabilities. But it comes out of that very logical statement that my net worth is derived from my assets minus my liabilities. So whenever we're working with a transaction, we're ultimately thinking about the effect of the transaction on this accounting equation. And at the end of a transaction, when you finish doing our accounting, this equation must be in balance. Now remember that thing in maths, whatever you do on the one side, you must do on the other side. So it must stay in balance, whatever you do. So let's take the first transaction. The owner put furniture into the business, 24,000 Rand. Now, furniture is an asset, so we're going to increase furniture. And if we go down to the equation, assets has gone up by 24,000. Now you'll find out soon enough that equity, one of the components of equity is the capital. And if you just work this out logically, the owners put this furniture into the business. That furniture is not a loan to the business. It's if the business went into liquidation, it's not possible for it to go into liquidation on its own because the owner is actually the business, if it's a sole proprietor. But just for the purpose of what I'm saying here, if something's not a liability, well then it must be equity. The owners put the furniture into the business. If the owner said that the business owes me this furniture, that would make it a liability. But because he contributed it to the business, it's an equity balance. So if you have a look, these are the components of equity. There's capital, and my capital, the owner's capital, has increased. The second entry, the counselling sessions, we've already done the maths. It's 100,000 Rand for the year. So we know that this money, it might have been banked every day, it might have been banked once every second day, every week, month, whatever. It could even have been banked at the end of the year. But my bank has gone up by 100,000 Rand. Now another component of equity is the income. And the service was rendered, and we can say that the effect of this transaction on equity is that equity has increased. Now remember, when we're thinking about this increase here, we're thinking not in relation to income, we're thinking in relation to equity. So the third entry, we paid our lights and we paid our rent, and that was in total, we paid the landlord 40,000 Rand. So the bank has gone down, the bank is an asset, so I'm going to subtract 40,000 under assets. Now under my expenses, remember, I'm not going to say plus for rent because I'm thinking about the effect on equity. So I'm going to minus, the rent was 28,000. So minus 28,000. And then the electricity was minus 12,000. If you go and have a look at your accounting equation, your assets came down by 40,000, and remember your expenses decrease equity, that's come down by 28 plus 12. So you can see that the equation is in balance. And then finally, transferred 48,000 Rand to him personally. Well, the bank has gone down by 48,000. So minus 48,000. And what's happened to this expense, salaries, minus 48,000. Once again, you can see the effect on the equation. This minus over here, it's not in relation to salaries because the salaries is actually increased, but you're thinking about the effect on equity. Going to the equation, you can see that the bank is an asset, it's gone down. Equity, the expense has caused equity to go down. It's in balance. finally, we can balance off this thing. Now remember, this company or this enterprise, the sole proprietor business, started this year. So if I go and add this all up, we got 100,000 rand in. We pushed out 88,000, which leaves a balance of 12,000. The furniture is 24,000. The capital is 24,000. The income from services rendered is 100,000. The rent is 28,000. Electricity is 12,000. And salaries are 48,000. Now if we just go and quickly work this out, 12 plus 24 is 36, plus 24 is that's 36, right? If I look at my equity, it's 124 minus 28. See, 124 minus 28 minus 12 minus 48 equals 36. So you could say that these two are 36 and my equity is 36. You can see that my assets equals my equity in this case. When we come back, we will quickly look at the rules to debit and credit these accounts, to learn which accounts to debit, which accounts to credit, and then we'll go and put them into the trial balance, into the general ledger. After that, we'll put them into the trial balance and then prepare the financial statements.